utiliser le micro sans fil. Libre à vous de poser des questions dans la langue officielle de votre choix. So, who wants to go first? Fergal.
Smith, Reuters. Congratulations, Governor.
Thanks, Fergal. Got a ways to go yet.
Of course, yeah. So, since last week's policy meeting, we had the November employment report. Does that report diminish the bank's confidence in the resilience of Canada's economy?
No, we don't normally put a lot of weight on individual data points, especially in the labor market report, which is a very volatile report. Nor did we put a lot of weight on the extraordinarily strong numbers that we received earlier in the year. So you tend to see through these things and watch the trend. And the trend has been quite a positive one for the labor market, and certainly in the details, as I mentioned in the room, that employment rates are up, participation rates are up, and unemployment rates are all down across the board by age group over the last few years. And we've reached a stage now where we're getting more and more evidence that wages are picking up. And when I talk to CEOs of companies, the first thing they tell me is they're having trouble finding the workers they need for their company. So I suggest that we're in that neighborhood where we're at a nice spot in the labor market. Of course, we have pockets of weakness. Canada is always like that, where it's excessively hot in some places and still cool in others. But on average, it's in a place where we can watch the rest of those, I feel like, imbalances work their way out through time.
Still, Governor, I guess it's the second month in a row that we've seen a decline in jobs. If that were to occur for a third month, would that be something that would put that discussion of an insurance cut back on the table?
So we would not just be looking at employment, of course. It comes in the fullness of a lot of other indicators, which may be more, if you like, current or current's fundamental, if you like, is a better term. Historically, the labor market tends to be a bit of a lagging indicator of what's happening next. So that would be one thing that we would consider in light of data, but I'm not going to answer a hypothetical like the way you pose it. What we're watching for, as we said in October, and again in our December decision, is we're watching for signs that the global shock is affecting not just our manufacturing sector, which of course it is, but that it's beginning to spread into other parts of the economy. We said as long ago as April that the shocks that we're dealing with, these trade-type shocks, are shocks to the level of activity, the level of investment, the level of exports, level of imports. And what that means is when the digestion effect is over, the growth rate tends to resume. And that's what I think we're seeing in the global economy, a bottoming out of most indicators. And that suggests that, yes, adverse trade policies have cost the world probably $400 to $500 billion, and that will be a permanent loss in the level of activity. But over the next year or so, perhaps after all the digestion is over, the growth rate in the global economy can be restored, not to a strong growth rate, but a more, I feel like, a stable one.
I've got Shelley followed by Dave.
Do you anticipate that the wage gains will continue to rise in light of low productivity?
Well, that's a good question. I mean, one of the things in here is that we've had a pretty prolonged period of wages running, a little slower than we might have expected by our models, and we're just in the last, say, 6 to 9 months or thereabouts, seeing a noticeable upturn in our core measures, which try to extract all of the noise from the various series. So that suggests that the wage Phillips curve is intact, and that it's showing us that the pressures that that companies are telling me about are starting to result in higher wages. So as long as those conditions persist, you'd expect those wage increases to persist, because what matters here is the companies can't produce more productivity without the right match in the labor market. If they're struggling to get the right workers to grow their company, that's one reason why productivity can seem slower than it otherwise would be. So we see underneath the surface a lot of churn in the labor market. Going back to Fergal's question, in a given month, a lot more people lose their job than what it looks like in those statistics. And a lot of people also get new jobs. And it's that churn, which is a positive signal for us. Churn has been rising for more than a year now. And what that means is people are finding their way to better matches. And also, on average, the average wage increase of people who switch jobs is very high. It's in sort of 10-12% range, because people are finding the right matches. And those matches inevitably bring higher productivity. So I'm expecting the statisticians to find more productivity as we go along and kind of square that circle for you.
And then you also talked about how Canada will have to rely on outside for the labor force, so immigration.
Yep.
What impact does immigration have on productivity?
Well, I don't think there's a statistical relationship there. The broad statistical relationship is that immigrants tend to create more businesses than disproportionately more businesses than folks that are already here. That may result in more productivity, but I couldn't assert that. But it does boost the firm creation statistics, which can often be a source of new productivity. But otherwise, I don't think there's any stats that discriminate between new Canadians versus people who were born here in terms of productivity. I think if people come here and they come through a system with job skills and they find the right match, they're as productive as anyone else, of course. So,
Dave?
Dave Parkinson with the Globe and Mail. Governor, wanted to ask you a little bit about something that came up in the Q&A after the speech, when you were talking about perhaps a preference or a possible preference anyway of stimulating more government debt through fiscal measures rather than relying on monetary policy that, as you pointed out, at low rates stimulates more household debt. That trade-off there, or that balance there, suggesting that perhaps a balance tilted more towards the fiscal side might make more sense and might be more manageable. I guess I'm just wondering. Obviously, we've got a new government on the verge of presenting a new fiscal update. Wondering what you can, if you can expand a little bit on where you see that balance right now, and what might be a preferential situation.
Well, first, Dave, the question that was asked of me is, what do I think about negative interest rates in the world? And what I was talking about is, in the situation where you're driven to, on monetary policy side, to negative interest rates, it's almost certainly the case that using fiscal policy instead would be preferable. We know since 1936, when Keynes wrote about it, that fiscal policy is at its most powerful in the situation where interest rates are very low and expected to stay there. So bang for buck is higher, and monetary policy is at its most feeble. So that's the context in which the question was posed and how I answered it. I'm not going to comment on what the new government may or may not do in its fiscal front, although the minister has already announced that they will go ahead with a tax cut, an income tax cut. And that amounts to something like, if I remember correctly, $3 billion of stimulus in the first year, and gradually grows to more. So that is something that we'll need to take into account when we next figure out how the macroeconomy will evolve. And then, of course, it'll be in our new forecast in January.
Wanted to ask you a little bit, too, about the business investment figures that came out in the third quarter GDP. I know that Tim Lane made reference to those in the speech last week. Just wondering what your views are. Obviously, that number was much stronger than we had anticipated. What is your best guess about what was going on there?
Well, I don't have a guess of any kind, really, Dave, best or not best. But I mean, it's any number that comes out that's really surprising, immediately draws your attention, and you're trying to analyze it every which way to see how much of it is real. Fact is, though, that we've been going through a period of quiet investment, and we expected this year to see investment pick up speed, if only because the government had introduced faster capital consumption allowances, so faster depreciation rules, and that would very likely give us higher investment than otherwise. We started off the year strong, and then we faltered again. So in some respects, it's reinforcing to see the third quarter come back, and if we average through the quarters, it's altogether it's strong. It's stronger than expected, but it's of course much less surprising than if you just look at the one quarter by itself. Again, you have to distinguish between those fundamentals and maybe there were special factors that boosted it temporarily. So we'll have to give a much more vigorous analysis of that in our January update, because otherwise we won't have a full story about investment going forward.
Okay, I've got three more here, and then Jeff, and then Ian.
Governor Andrew Bell of BNN Bloomberg. In your speech today, you said the high household debt load is the most important risk facing the financial system. But aren't you the man who's to blame for that? You're the candy man. You kept interest rates so low all those years. Didn't you? You're the main author of that bubble, aren't you?
Well, I guess a lot of things may have contributed to it, Andy, but certainly I would say that keeping interest rates low, as many countries have had to do for over 10 years now. If we go back to 2008, 9, 10, we had a lot of fiscal action at the same time as monetary stimulus. And then globally, we saw enough of a recovery at that time in 2010 that governments decided, well, okay, we got things back on track. So they began consolidating the fiscal side, and monetary policymakers, figured we'd be coming out of it too. But then the world economy faltered again, and as I said, we had that sort of the period that we called, serial disappointment. And it's in that phase that monetary policy kind of got stuck in this very stimulative place, offsetting headwinds that are hard to really quantify by conventional analysis. But they're obviously there, even though the Canadian economy is at full employment, more or less, and inflation's on target. We're there, but with really low interest rates still from a historical standpoint. So those low interest rates are still stimulating against some contrary force. So, I think the fact that inflation is on target today suggests that the Banque du Canada has done its job. Now, if there are side effects, and one of them that you're mentioning, those are, they're secondary effects. They are not our prime mission. Our prime mission is to stabilize the economy and keep inflation on target, and we've succeeded with that. We've introduced, we being a broader we, macroprudential measures to try and deal with financial vulnerabilities, and they have succeeded. So now we know that every new mortgage that is created is far more sustainable than mortgages that were being granted before those changes. And that gives us confidence that as things move along, even if debt continues to rise, the sustainability of the stock of debt is improving every week.
I mean, it hasn't been easy being a central banker over the past decade.
No.
There's been the mysterious absence of inflation. And as you know, central banks around the world have kept money super low. Mm-hmm. But Paul Volcker just died, and he was praised for taming inflation. That was a different era. Are you worried that your legacy could be seen as leaving Canadians with a bunch of unsustainable debt?
No, and I don't see the stock of household debt as unsustainable. That's an important distinction, Andy. I see it as a vulnerability. If a nasty shock came along and unemployment in Canada rose significantly, and these are the kinds of stress tests that we run in order to analyze that vulnerability. If that were to happen, then the effect of that shock would be magnified. So we would have a bigger and probably more prolonged recession than we would if the debt was not there. That's the sense in which it's a vulnerability. However, even with the most extreme stress scenarios that we can bring to the picture, things that basically combine, the worst of 1981 with the worst of 2008, et cetera, we put all those things into one big shock with falling house prices, rising unemployment, and big recession. Our financial system remains very resilient through those experiments. Now, that's to say there would be people who would be suffering from those recessions, of course, with high unemployment, possibly having to default on mortgages. I'm not dismissing that. That matters a great deal to me. But from our point of view, the reason we consider those experiments is to understand the resilience of the financial system itself. And the changes that have been made under Basel III and subsequently have made both the household sector more resilient and our banking system far safer than it was before 2007.
Thanks very much, Governor.
Over to Ian.
Ian Biggis for the Canadian Press. Just what should the government look for in your replacement as they start the search?
Well, look, it's not for me to discuss. I mean, I think they would look for someone with the same qualifications they've always looked for, and there are, I'm sure, plenty of qualified candidates. I'm not going to say there's some specific things they're looking for.
Fair enough. And then just on the new NAFTA, do you expect that now that it is more formalized, what kind of effect will it have going forward?
Well, there's no question that the uncertainty around the future of NAFTA began to bite almost immediately after President Trump came to office, because the first thing that he said he would do is to tackle NAFTA. So for 3 years, Canadian investment has been lower than what our models suggested it would be. And we had to keep judgmentally changing our forecast for investment as a result of that. And there's no model for this. It's just uncertainty. So you're kind of tracking investment lower and saying, well, that's probably the worst it can be. And from here on, kind of be conservative about the outlook for investment. And that's turned out to be right until, as I mentioned before, this year we've gotten some movement. And so that movement we got this year could be resolved. A year ago we got we got something signed, right? So that gave us hope, and we also had an announcement by the government of faster depreciation allowances. That was to kind of match more or less what was going on in the U.S. tax system. So that those changes together could give us a brighter 2020, but we didn't assume it. Sorry, 2019, I misspoke. A brighter 2019, but we didn't want to assume it. We wanted to see if it came. First quarter, that looked pretty good, but then second quarter, the reverse. Third quarter looks really good. So we'll see in the fullness of time, but I think that the actual finalization and the ratification is crucial because it's an uncertainty thing. And that, of course, is very hard to measure. It's just sentiment. But there's no question about its presence in the data. How quickly will it turn around? Some investment decisions have been made during that period. Investment, I was asked about it in the room. Some investment went somewhere else. Well, that doesn't get reversed just because we ratify NAFTA. But if it's been put on the shelf until we get clarity, well, that can make a difference to the outlook. So I'm going to say, well, we should wait and see it before we assume it. But my presumption is that the ratification of, I guess it's going to be called CUSMA or USMCA, I'm not 100% sure what we'll come to call it routinely, that will make a positive difference to investment sentiment in Canada. I'm quite certain of that. I can't put a number against that at this stage.
All right, we're almost out of time, but I'm hoping we can get in one and maybe two more questions. So yeah. Jeff and then Kim is the other one who wanted to ask.
Okay.
I'll talk quickly. Jeff Scotty from the Financial Post. Does the fact that Canada is now in this minority government situation change anything at all for you, whether it be how you operate or your forecasts?
No, I mean, government to us is in a pure sense is just a line in the economy which we have to try and figure out. And we basically, instead of predicting it, we take what's been announced and incorporate it in there, and then that helps change the baseline of how the economy will function, and then it gives us an insight into where inflation will go under our base case and whether policy needs to be adjusted. But that's all. I mean, of course, it's possible it will mean business uncertainty, but I think the government has every incentive to be as clear as possible. And you know, the NAFTA is a great example, which I think would cement, you know, a stronger profile for investment. And so no, it's not going to change anything. But the political stuff is, well, it's politics. You know, we just doesn't go into our equation anywhere.
So it doesn't even factor in that, you know, a government may not be able to get certain things passed because they can't have the parties agreeing on?
Well, if something they were going to pass didn't pass, then it wouldn't get incorporated in our forecast. And we wouldn't incorporate it into our forecast until it was passed anyway.
Okay, Kim?
Thanks. Kim McCrail from the Wall Street Journal. Governor, I'd like just to ask you to reflect on your decision, if you don't mind, to step down at the end of your term and the decision to announce it when you did.
Well, I mean, the term is a defined term, and it ends June the 2nd in 2020. And so given the needs, if we're going to have a process for selecting a new governor, it needs to get started very soon, so that kind of decides the timing. In a broader, taking your question more broadly, as I've said before, this is my dream job. It's been wonderful. I feel very proud of the team that I've worked with and what we've been able to accomplish together. But for me, I think it's about time to do something else.
Can I ask what that something else might be?
I actually have no idea what that something else might be, but governor positions come in blocks of 7 years, which is a very large commitment to make for a second go round, and I felt at this stage of my life it was not for me to continue in my role. So yeah, so I'm going to work really hard for the next 7 months as usual, spending a lot of time on mentoring of the senior staff at the bank, something like 25 or 30 people, the top people, and doing as much of that as I can, and fulfilling, of course, all my other regular obligations to the best I can.
Great. Thank you. That concludes the press conference. Thanks, everyone, for coming.
Thank you, everybody.